Hi, everyone. Thanks for joining us today. I'm Ritesh. I head up the investment advisory team at Syfe. In today's session, we will basically cover the recent China market crash, the implications, which are short-term as well as long-term implications of the recent changes that we have been observing, as well as our outlook on the China market going forward. Joining us today is Samantha, who's recently joined Syfe. She has a 15 plus years of research and investing experience, having worked at institutions such as Morgan Stanley before, and more recently at Broadpeak, which is one of a multi-billion-dollar hedge fund. So without further ado, Samantha, over to you.
Thanks very much, Ritesh, and good evening, everybody, and thank you very much for joining us tonight. So I know for many of you watching, and you're either invested or taking a keen eye in the market about what's going on right now, and China is a very hot topic at the moment. After some sharp falls and significant underperformance that we've seen across multiple Chinese stocks over the last few months. This is also in a context of an environment where we've seen global equity markets continue to hit new highs. So we wanted to take you through a rundown of what's happened, plus what this means going forward, and how you should think about investing in China, as Ritesh mentioned. So let's go to the first slide, Ritesh. So what has happened? Over the last 10 months or so, we've seen in the Chinese market that there's been numerous sectors and companies that have been hit by a wave of regulatory crackdowns. When we break up these regulatory events, we can basically put them into three broad buckets of behavioral reforms that the government has been targeting. So the first one is antitrust, or also known as anti-competitive or monopolistic activities. The second one has been around data privacy or data security. And the third has been around social equality and social or community responsibility. And let's go through each one of them and give you some examples of what's happened. So firstly, we see antitrust activities. And this is where we've seen the bulk of regulations concentrated so far. It started with the suspension of Ant Financial IPO at the beginning of November last year. And this was due to both the perceived risk of the threat to financial stability in the broader banking system, from fears of how large the peer-to-peer lending market had become, as well as the significant market share and monopoly that Ant Financial was capturing and controlling of it. This was then followed up by the antitrust probes into Alibaba at the end of December, also last year, which were centered around the so-called 2-for-1 practice, where large companies with significant power in markets like e-commerce, as is in the case of Alibaba, was basically forcing merchants who list on their platform to sign exclusive deals with them and not list their platforms on any other once they did that. So, for example, if a company listed their products on a Taobao, they were not then allowed to list on a JD.com. This is also more recently manifested itself in some actions against Tencent around both the music and entertainment side, also related to the use of exclusive contracts and their potential abuse of monopoly power. So in the next bucket, we see the activities have been around enforcing data privacy and data security. So this initially came through with Didi in the ride-hailing segment. And this really shook the markets because it was a probe into Didi's cybersecurity policies and protection of user data, but it was revealed just days after their big IPO in the US. It forced Didi to basically be removed from the App Store, and as you can imagine, led to a big drop in their stock price and significant investor outrage over the timing and the disclosure of the investigation, and questions around why this was not disclosed in the course of the listing. Another example of this has been with WeChat, and this is also owned by Tencent. They were another target in terms of potentially having insufficient policies around the protection of their user data. And if you recall, Tencent in this case acted very quickly and basically preemptively canceled new user sign-ins so that they would not fall further foul of regulators. In the next and final bucket, and a very important one to point out, has been around social equality and responsibility. So these reforms have centered both around workplace and employee welfare, plus also broader social and community equality initiatives from the government. So on the workplace and employee welfare front, we saw this most evidently in the case with Meituan, which is a food delivery provider. So authorities have come down very hard on them around the well-being and maybe lack of well-being and treatment of their gig economy workers, around how much they were getting paid, how many hours they were working, and around the lack of social welfare plans that they had in place for them. Also, getting a lot of news recently and had a significant impact on the market was the reforms around the after-school and for-profit education and tuition segment. So this saw sharp drops in the likes of TAL and ADU stocks after basically the authorities wanted to regulate this industry similar to the way that they regulate the broader education sector. And, I guess if we think about this, really the concern here and the driver for the government was to reduce the financial burden on middle-class households who have had to continuously spend more and more on these after-school tuition services in order to just keep up with peers and get their children into decent universities. So if we take a step back on this, this is pretty aligned into China's goal in how to think about the aging population and low birth rates by reducing some of the barriers and hardships that people feel that prevent them from having more children. So if we put these together and think a little bit about what this means and what the likely implications of these measures are, I think firstly it's important to remember what is the Chinese government's guiding principles. And these really center around two broad frameworks. The first one is social harmony and community responsibility, and second around financial stability. And if we look across all the reforms that have taken place so far, they can really be brought back to these two major principles. And if we go a little bit deeper and touch into some of the likely implications, I guess firstly, we see that the likely outcome is we see greater transparency, both in terms of the way companies store data, in terms of how companies price their goods and services, etc. And secondly, we are likely to see reduced inequality as the government attempts to level the playing field across the economy. Thirdly, it's likely that we'll see reduced M&A and market listings with the level of scrutiny and potential, I suppose, canceling of transactions that potentially lead to monopoly creating or enhancing situations. Finally, we see that there could potentially be increased competition as less and less monopolistic practices allowed, such as basically a large company using their one core business to subsidize another smaller loss-making business as they try and drive out competition. This does mean that some of the large companies we see right now could have lower profitability going forward. But generally, this results in better outcomes for consumers, both in terms of pricing and choice. So all this means together that we are likely to see higher short-term volatility, but the potential is that these long-term benefits lead to greater stability, etc., which we'll touch upon a little bit more in more detail later. So another big question is why now? And really, a lot of these objectives from the government have been in place for a number of years and are not really that new. But we're just now starting to see a lot of these practices and goals of the government being basically implemented. And the timing could be influenced by a number of factors. Firstly, governments tend to have more flexibility and room to do some of these sweeping reforms when the economy is doing well. And with the strong recovery we've seen in China post-COVID, until very, very recently, it has given the government more confidence to take some of these bold moves. Plus, I think one big driving factor is this K-shaped recovery that we've seen post-COVID globally. And this is the case of where the haves are getting more, I suppose, or you could say the rich are getting richer, and there is a bigger gap between the higher income brackets and the lower income population. And so that's given further urgency to China and importance around some of these regulatory actions, and particularly the ones that are about social equality and responsibility. And finally, another consideration we could think about is that this is a pretty important policy year for the government, because next year will be the Communist Party's 5-year National Congress meeting in the second half of next year, and therefore they have some urgency to see some progress towards their policy goals in the next 12 months or so. So I know all of you are wondering, well, this is great, but what does it mean for my investments? So what this has meant is that we've seen a significant underperformance in Chinese stocks, and particularly Chinese internet and tech stocks. This started from late February, when we basically first had the release of regulations around anti-monopoly laws. For example, banning forced exclusivity practices. And this has basically gotten more and more stark with every subsequent regulatory event. And the net result of that is that year to date, MSCI World is up 16%, and global markets keep hitting new highs. But MSCI China is down 11% for the year, and a proxy for tech and internet stocks in China, MSCI China Tech 100 is down 18% for the year. And if we take a look at a little bit longer term, so the next chart, yeah. And so the correction here is even more stark. So MSCI World is represented by the blue line, is at all-time highs. And to give you some context, it's actually up 60% in just over 2.5 years. But China, on the other hand, is back to its pre-COVID levels, which means basically, it's back to levels before we saw this, pretty unprecedented level of fiscal and monetary stimulus hit global financial economies and markets, and essentially, massive amounts of liquidity that have driven up, asset prices and valuations globally. Another important point to point out here is that basically, if we look at and highlight some of the individual China internet stocks, and here you can see the orange line is Alibaba and the yellow line is Tencent. Basically, these stocks are down 40% from their peaks. And really, it started, as you can see, in November 2020 for Alibaba, when the Ant Financial IPO suspension hit, and it's essentially just gotten worse since then. So on the next slide, we show basically a quick look at valuations and what does this mean that the market is implying. So this chart here is the 12-month forward price to earnings multiple. Essentially, the higher the number, the more expensive the stocks are trading at in terms of the earnings that they're generating. So as we can see from the chart, so the global markets, which is represented here by S&P 500, which is the orange line, and the blue line, which is again MSCI World, are near their all-time peak high valuations. However, China in the black line is now trading at a significant discount and is again close to its 2019 and pre-COVID levels, despite what we believe is some positive long-term growth outlook and numerous structural tailwinds. So this implies that the market is actually pricing in significant risks and lower returns for Chinese stocks going forward. And while we agree that there are clearly some hits to profitability for large cap monopoly companies in China, I think a lot of this has been reflected in earnings estimates cuts already. And if we take one example, basically Alibaba missed its revenue estimates early this week, I think for the first time in 2 years, which normally in a normal situation would lead to a sharp correction in the stock price. But if we look at what happened this time around, the stock was only down 1.4% and bounced back right the next day. So this shows us that quite a lot of bearishness and negative sentiment has already been priced into some of these stocks and into the Chinese market. And to give you some further context, both Alibaba and Tencent are trading around 20 times price to earnings, and that's basically at their all-time low levels versus some of the crazy multiples that we're seeing in multiple US growth or internet stocks at the moment. So what does this all mean and what could come next? I think everybody's wondering and trying to guess where the next reforms could come from, which sector or company it could be. And I think I just saw the headlines just now before this webinar that there was even liquor stocks and tobacco stocks is getting hit now because that's the next rumor of where we could see further reform. But if the past is kind of anything to go by, it's very difficult to identify where regulators will focus next. And also, basically any time that there is any speculation at this point, we're seeing, wild stock price moves and action. So what could we see possibly be some of the potential support measures coming in the short term? I think our general premise is that we don't believe that the Chinese government wants to, bring the market down as a whole. And some of these measures, all of these measures, I should say, are being pretty targeted and at specific sectors and specific behaviors. And we do see that there could be some potential support levers coming, in the near term. So firstly, I think, this concept around financial stability remains, very important for the government. So any wild moves in the stock and markets overall and risk contagion that could potentially lead to a fall-on effect in the real economy would be very negative for the government and growth in China. And we believe that this will create some floor on equity markets before we start to see perhaps some stimulus, etc., coming through. And also, if we look at where the growth cycle is right now in China, we expect that there could potentially be some fiscal stimulus coming in the second half to ensure that they hit their growth targets, and particularly given the fact that we've seen, recent outbreaks of the virus in China. And typically, when we do see fiscal stimulus come through, these are generally positive for equity markets. So longer term, we believe that while these reforms will create some lower outsized returns for large monopoly companies, the release of these more policies will eventually create more certainty, more stability, and more transparency around the regulatory framework as a whole. And while they also will build in higher consumer employee protections and potentially reduce the wealth inequality, we think that really generally together these should mean that we see higher quality of growth going forward, and hopefully a more stable return profile as well. And generally these should be net positives for both the economy and the market in the longer term. So to wrap things up, what are some of our key takeaways and messages? I think firstly, taking a longer term perspective, we remain positive on China. The structural drivers, that were there before the reforms remain in play, and some of these could actually be enhanced by the recent measures. And the most important message I think that we want to leave you with today is that these episodes have really shown us, the difficulty in both timing the market and choosing companies or even sectors to invest in, which highlights, the importance of being diversified in your investment portfolio, not just in terms of companies, sectors, but also in terms of, countries, markets, asset classes, etc. Plus, the importance of being able to take a longer term view and see past near-term volatility. I think that's all from me, Ritesh, if you want to continue.
Hey, Sam, thanks so much for covering. I think, it was great to sort of, understand what's going on in China right now. And also structurally, how can investors think about it going forward? We do have a few questions that have come in, in the interim. So I was thinking maybe we cover a few of them before we move forward.
Sure.
All right. So I think like a broad level question, again, is on the recent crackdown on the education sector per se. And I think you covered it a bit in terms of what is the rationale behind the government going specifically after this particular sector. But if you could elaborate a little bit more, I think like, one of our attendees are asking about this particular, action that has been taken.
Sure.
And the reason behind it, basically.
Sure. So I think as I mentioned, I think the primary reason behind this is because China wants to basically encourage people to have more children, right? And address that aging population issue right now. So a lot of the thinking behind this was basically on that premise. And as I mentioned, this is about reducing any barriers or potential reasons for people not to have more children in China and take away some of that stress that is currently caused, right? So I think that one of the common reasons that people are not having more children is because of the sheer cost, right? The sheer cost in terms of housing and the sheer cost in terms of education, because it's not now basically their general education, or I guess what you would call their primary or secondary or core education. It's basically that most of this has been driven by a very competitive nature to get into universities, and therefore have to spend these after school tuition services have basically become a necessity, and become increasingly expensive, and the government is seeing how much money these companies make, and that's been a real kind of driver for them to try and make them non-profit, and kind of I guess level the playing field, if I use that phrase again.
Got it. Thanks for covering that. I think a big question on investors' mind, and there are two kinds of investors, right? Like, investors who do not have exposure to China, and, is this the bottom? Shall I start investing? That kind of a thing. Versus another kind of investor who already have exposure to China, and they are sort of scratching their heads right now. What do we do next? So any views on those?
I think this is as I maybe says on this final slide, timing is extremely difficult here. I think it really depends on your time horizon that you have. If you are trading for the short term, I would probably say it's very difficult to predict what's going to happen, and there's going to be a lot of uncertainty, maybe possibly for the next 3 to 6 months. But as we mentioned, I think longer term, the positive drivers for China that existed 12 months ago, 24 months ago, are still there, and we don't see that changing. And if we look at the valuation discount and the underperformance that we've seen in China, we do believe that eventually these will catch up. It's just a question of when, and that when is extremely difficult to predict. So being again diversified and maybe averaging in is probably a good strategy for now.
Actually, that's a good segue into this next question, where someone is asking, is DCA into individual stocks right now the right way to invest, or like, is it, ETFs the right way to do it, right? And which is like, the right way to sort of lower the risk of currently people who are invested into China?
I would definitely say that, going for the broad market and ETFs is a much lower risk strategy, right? Because as we've seen, any company could be targeted. And at this current time, we can even look at the example of both Alibaba and Tencent, where they have been targeted multiple times. So not just if in one case, if you say, okay, well, there's been one reform on e-commerce, the e-commerce sector, and it's not going to happen again. That hasn't been proven correct so far. I think, there has been a number of times where we've seen, one fine, and then maybe it's been followed up by, a second one, etc. So I think it's very difficult to, pick sectors and companies right now in a market like this, particularly where we see, such sharp moves based on some of these regulations, right? So it's very difficult, very easy, to get caught out. So definitely, buying the market, and again, remaining diversified is a less risky and safer approach.
Thanks, Samantha. A lot of questions actually coming in right now. I think people are just latching on to all of these questions, and I think like one big question again in Western minds are Chinese equities which are listed on the U.S. stock exchange, and the potential implications, like if measures such as these will have any implications specifically to these offshore listed ETFs as well as these individual stocks.
That's a good question. I think that's a question that's on a lot of people's minds, and there's been a big debate in the market at the moment. I think if we look at some of the actions of the regulators, it can be construed that, or maybe thought that they are targeting, U.S. listed stocks versus Hong Kong listed stocks or Asia listed stocks, etc. But I think if we look at some of the actions of the regulators, post some of these moves and moves in the stock prices, I think we can see that that's not really what's been the case, right? What's been targeted is really activities and behaviors around these the goals of the government, right? And going back to the kind of social harmony and financial stability, right? But if we look at what happened post the sharp falls in the education stocks as one big example, those were listed on in the U.S. markets, and that really worried a lot of investors that they were particularly targeting those companies listed on the U.S. stock exchanges. But actually, after those big market moves, regulators called in the number of leading senior managers from a number of investment banks, including foreign investment banks, to calm the market and to ensure them that this was not a broad stroke move from them, and that they were not looking to basically stop the practice of Chinese companies listing in the US.
Right, and I think also there has been, the Chinese government has also come out and recently tried to assuage a lot of investors in terms of, not, sort of thinking over it in a manner which is sort of detrimental overall. So I think it is important to put all of this in context of what China is actually trying to achieve, rather than thinking of it as, something that they're doing a crackdown on specific offshore listed companies or other such things. It is more to do with the overall structural reform that they are undertaking, rather than something very specific with respect to, say, US-China trade wars and stuff like that. I don't think those are the reasons, and I think, Sam, you covered them pretty well in terms of what are the actual reasons why China is actually taking these steps. So essentially, it is like getting something fixed for the long term and making short-term sacrifices.
Exactly. Painful short-term sacrifices.
Got it. So there are also a lot of questions that are coming in with respect to like Syfe portfolios and like, the impact of, these recent price actions on the Syfe portfolios and like how much of China exposure do we have in our portfolios as well, right? So maybe it'll be a good time for us to segue into covering a little bit like more introduction to Syfe and just, sharing with clients like, what kind of China exposures do they have with Syfe portfolios as well? So shall we move on to that section before taking? All right. Great. So let me cover this part. So I'll just cover a little bit more about Syfe. So Syfe is a digital wealth manager. We are headquartered in Singapore. We have a fund management license that allows us to manage money on a discretionary basis for retail as well as institutional clients. Now, in terms of our journey, what you will realize is we've had a very exciting journey. We have grown tremendously, and we are thankful for all our investors who have remained committed to us. We started somewhere in 2017. In 2019 is when we got our license. We have achieved various milestones, as you can see on this chart as well. We have clients ranging from 18-year-old all the way to 93-year-old, right? So just gives you the range of clientele that we have on our platform. In 2021, we grew our AUM by 4x. So again, showcasing how investors are loving investing with Syfe. We also, figure in the top personal finance app list. When you go on to App Store and all, you will always see Syfe at the top. We have very favorable reviews on Seedly. We've recently been awarded the best digital advisory solution by DigFin. So all of this has sort of helped also get investors a lot more comfortable and confident in using our platform. And most recently, we've had our Series B funding round that was led by Valar Ventures. And if you don't know Valar Ventures, it's a tier 1 VC firm backed by Peter Thiel. So Peter Thiel is the founder of PayPal, early investor into Facebook. So we've got like these very strategic investors. They've invested into some of the biggest fintech unicorns in the world. So they know the space, they know and understand what we are building, and they have supported us as well. Now, coming to our portfolios, what we espouse to our clients is to invest in a very goal-oriented manner. And to that effect, whether you have a savings goal, whether you have an income goal, or if you have a growth-oriented goal, there is a Syfe portfolio for you. And to that extent, if you look at the savings bucket, we have a cash plus solution, which basically invests into a mix of money market and short duration bond funds. And it projects a return of 1.5%. The good thing with this particular portfolio is that there is no lockup, there is no limits, there is no tiers. So oftentimes clients do use it as an alternative to their savings account. Now, the difference between this and a savings account, of course, is that this is not capital guaranteed per se, but because it is investing into very liquid, high quality money market bond funds, essentially it is very, very low risk in nature. Typically, we say that if you can hold your money into this portfolio for at least a month plus and all, you will usually have a much better return profile than money sitting in the bank. Typically, clients use this portfolio either to park temporary cash, they're part of their emergency funds, to fund sort of a purchase that is upcoming, say in 6 months' time. This is a great place to just like park that capital before you make that big purchase kind of a thing. A lot of clients actually also just put in a lump sum amount into the cash plus portfolio. And there is an easy way for you to transfer over these funds on a recurring basis to our investment portfolios. So, if you are afraid that the markets are on top and you want to, regularly DCA into the market, this could be a great way for you to deploy your funds. Now, while 1.5% is great, it still does not beat inflation, right? So if you really want to, make your money work harder and grow over time, then essentially you need to take a little bit more risk to those aspects. And then it comes to goals, right? Like, what kind of goals do you have? Do you have a more income-oriented goal? You want to generate, regular cash flows for yourself? Then maybe a REIT portfolio might be suitable for us. This REIT portfolio is one of its kinds. It tracks the IHS REIT Leaders Index. This portfolio has been built in partnership with the Singapore Stock Exchange. Right now, considering the bank interest rates, which are close to zero, this portfolio is giving a dividend yield close to 4.5% to 5%. So really, really attractive in terms of the kind of dividend yield that you can generate through this portfolio. And the great thing about it is the way REITs are structured, they have sort of a blend of both fixed income as well as equity-like characteristics. And what that means is while you generate this dividend yield, you will also participate in the long-term price appreciation of these REITs. So typically, if you have an income and growth combination goal, this could be a great strategy for you to try out. So this is Singapore dollar denominated. There is no sort of direct currency risk and all per se as well. So this is a great way for you to get started if you like real estate, if you want to have a regular passive income kind of a profile. The other bucket, the last bucket that we would focus on is a growth-oriented bucket where essentially you want your capital to grow over time and you have long-term goals or medium-term goals such as retirement planning, financial independence, children's education. These are all goals for which you want your money to grow. And to that extent, if you want your money to grow, you need some exposure to the equity markets. Now, depending on the time horizon that you have, depending on the risk appetite that you personally have, it is great for you to blend this equity exposure with asset classes such as bond and gold, such that you bring a little bit more stability and consistency in your sort of risk and return profile as well. So to that extent, we have this core range of portfolios, which goes from defensive, balanced growth, and equity 100. And the difference between them is pretty straightforward, right? Like, if you go for defensive, it has 20% allocation to equity, around 80% allocation to bond and gold. As you move to balance, the equity allocation moves to 40%. The growth portfolio has a 70% allocation to equity, and then equity 100 is a 100% equity portfolio, right? And if you look at these red triangles, it basically depicts the kind of risk that you're taking. So as you move from defensive to equity 100, the risk increases, but that should also translate into higher long-term returns. So the fluctuations in the volatility of these portfolios increase as you go from defensive all the way to equity 100. And simultaneously, the expected return of these portfolios increases as you move from left to right as well. Now, I don't think we have time enough to cover the detailed strategy of these portfolios, but one quick thing about how we construct these portfolios is by using what is called a smart beta strategy. And what that means in layman's term is rather than just like, when you're investing into equity markets, rather than having the biggest allocation to the highest market cap stock in your investments, which is typically done when you just invest in a broad-based ETF directly, you invest in a more factor-based manner and in a manner where you can justify returns that are generated because you're taking specific, factor exposures per se. So in our, portfolios, what we do is we take into account factors such as growth, such as value, small cap versus large cap stocks, emerging market exposure, as well as reducing the overall volatility of the portfolio. So some of these factors are things that actually drive returns to your portfolios. And that is what I think is done in a very systematic manner in our portfolios to ensure that you continue to do better without really taking excessive risk. Now, in terms of, I think there were a lot of questions in terms of Chinese market exposure through our portfolios. So the cash plus REITs have sort of almost minimal and to no exposure to China internet stocks per se, like those sectors which have been particularly affected through the recent price actions. The core portfolios do have some exposure to China, but because these are globally diversified portfolios, the exposure to China typically range between 3%, which is in the defensive portfolio, all the way to 15% in the equity 100 portfolio. So the point again is these are strategic allocations that have been done, keeping in mind the long-term growth opportunity, which is inherent into the Chinese market. And what that means is there might be short-term, disruptions that you might see in the Chinese market. But because our portfolio is overall pretty diversified, the impact of those short-term disruptions will not be felt in a very major way, right? So overall, the exposure to China is fairly limited. It is, between 3 to 15%. And long-term, we remain structurally, confident about the opportunity, the growth potential of China as well. And I think, as Samantha was mentioning, it is important to remain diversified, and that's what the core portfolios try and enable for you. Now, quickly, I think just covering our operations and license, and this is very important that we have a retail fund management license. This allows us to manage money on a discretionary basis for all clients. As part of this license, we are required to keep all client money separate from our own money, as well as client assets need to be kept completely separate and our own assets need to be completely separate. This ensures that, God forbid something happens to Syfe, your assets are safeguarded because these monies and these assets, we can only touch it to execute, and invest on your behalf. We cannot sort of take it out and, put it into our pockets kind of a thing. So there are all these bells and whistles that are put in place when you are investing with a CMS license holder such as Syfe. And what that ensures is, your money is safe with us. In terms of setting yourself up, it's pretty straightforward. We have our app both on the Apple App Store, on Google Play Store as well. You can just quickly go online, search for our app. You will be able to download it. You can browse through all our portfolios. Even before creating an account, you will be able to understand what these portfolios are. You can understand their compositions, their past returns, as well as you can see the projections of these portfolios going forward. If you want to, then go ahead, you can onboard yourself, and it's essentially just a 3 to 5 minute process because we have integrated MyInfo. Once you are on the platform, it is highly transparent in terms of your investments. You can see the current values, you can see the transactions, you can see the composition, you can see each and every fees that you have paid. So all of those are transparently shown to you. Now, one promise that we have to our clients is that we will make sure that we keep our costs bare minimum and as low as possible, and pass on all the cost benefits that we get out to clients as well. Plus, as you put more money with us, the scale actually, becomes bigger and bigger, and you enjoy lower and lower prices as well. So essentially, we have no minimums when it comes to if you want to get started with our platform, but the prices do come down as you invest more, right? So it starts at 0.65%, but if you go to $20,000 and above, it is 0.5%. If you invest more than $100,000, it is 0.4%. And then above $100,000, it is 0.35%. And not just that, on top of this, we understand that a lot of clients do not know where to get started and what to see when they're choosing different portfolios. So we do have a dedicated team of wealth advisors and experts. So do take advantage of us, and we have slots available for you to speak to us on a one-on-one basis, as well as we organize open houses for everyone to join in and do a Q&A session with us as well. Just quickly wrapping it up in terms of pricing, why this is so attractive overall. There is no trading fees, there is no brokerage cost. We remove all these traditional hidden charges that you observe with a lot of traditional platforms. There are no entry fees, there are no exit fees. You can take your money out at any point of time, so there is no lock-in. All the portfolios are managed by us. We rebalance them and keep them optimized all the time. So we do all that heavy lifting. You don't need to worry about it. Dividends are automatically reinvested. And you can switch between portfolios without any extra cost as well, right? So all of these are taken care of by us. If you compare it with investing by yourself, of course, you can go ahead and choose your own investments, and that's a great thing for you. But bear in mind, the simplicity is what a lot of places gets clients in terms of not knowing where to go and how to get started. And overall, the fact that you can just automate all your investments, that I think goes a long way in terms of making your investments simple, automated, and regular. Right, so it just helps you invest in a more consistent, disciplined manner, and all these things come handy when it comes to long-term investments. Right, so you don't have to worry about creating a CDP account. You don't have to worry about rebalancing your portfolios. Your dividends are automatically reinvested. You don't have to worry about any brokerage fees that you need to pay, and you just have a small management fee for managing these portfolios for you. As I covered earlier, we have a dedicated team of wealth experts, so feel free to engage with us going forward. We have a bunch of webinars coming up in the near future, the next one being on retiring, which will be done by Sebastian Sieber, who is our head of distribution, and then navigating the markets for Q3 2021. So more like an outlook session going forward. Also, thank you everyone for joining in today. So as a small token of appreciation, we are giving out a promo code if you fill up this feedback form. So please take note of this QR code and do give us some of your feedback. And as a token of appreciation, you will get 6 months of fee waiver if you do sign up today. And I guess that's it. So let's open it up to some more Q&A. Samantha, I'm not sure if you watched some of the questions while I was covering these slides, but happy to take some questions. I guess both of us can take a few more. I think we have 10 minutes.
So I think, Ritesh, do you want to answer some of the, so there's a bunch of Syfe related questions. Maybe in terms of, I guess some people are asking, if they have equity 100, does monthly DCAs or a lump sum amount or invested, which is preferred?
All right, good question. So see, I don't think there is a preference of one over the other. If you just compare lump sum versus DCA, like let's take equity 100 aside, right? Like just lump sum versus DCA, if you just see data and go back and analyze it, what you'll observe is lump sum actually wins more number of times than DCA. And that's just natural because over a longer term, it's just an upward trending market. And what that means is if you put in a lump sum, while there can be short-term, ups and downs, but long-term as the market moves up, that lump sum value will grow faster versus if you're DCAing it and regularly the market is going up, then essentially you're buying more, but like you're buying at higher prices. So your average price increases in the long term. Now, having said that, we do understand that investing does come with its own set of anxiousness. So with clients who are not sure about the markets and they are just worried about high valuations and all, it's not a bad idea to combine the two aspects. So what that means is construct a solid foundation first, is what I would say. And when I say solid foundation, create a more diversified portfolio, which could mean a more core portfolio, which is across asset classes, rather than a pure equity portfolio to begin with. So that could be a good starting point for someone who is just starting off their investments and wants to deploy a lump sum amount of money. And then when it comes to monthly contributions, ideally the monthly contributions should come from your monthly savings. And these monthly savings then can go into some of these equity 100 strategies as well as your core portfolios. But the idea is it should be a blend of both rather than one over the other.
Agreed. I think there's some questions around how do we not charge brokerage fees? I don't know if you want to answer that question, Ritesh, and then we can maybe take another couple on China.
Absolutely. So that's a good question. And I think that's the value that Syfe brings onto the table for clients. This is not going to be possible if you are going to invest in a traditional sort of a platform. And this is where the power of technology comes into play. We have our own sort of proprietary fund management system, which allows us to, sort of aggregate all client investments in a way such that we can trade more efficiently, meaning that our brokerage costs that are incurred on a more institutional basis is much, much lower than every individual trading on their own accounts kind of a thing. Also, because we are an institutional sort of an investor, the brokerage costs that we incur as an institutional investor is much, much lower compared to an individual investor. And that's where the efficiencies and the scalability comes into play, that because we can manage this on a wider scale across our clients, you participate in that as well by sort of investing through the Syfe platform, because we absorb all of these charges and you only have to worry about like a small management fee.
I think there's also some questions around the exposure again of China in the relative Syfe portfolios, and how they're impacting the portfolios, right? So maybe if you want to touch upon where we have again where we have the biggest exposure to China and the smallest, and that can help some of the users.
Absolutely. So as I covered earlier, the exposure to China ranges between 3% to about 15% in our portfolios. So if you look at the core and equity 100 range of portfolios, the core defensive portfolio has a 3% allocation, around 3% allocation to China, versus the equity 100 has close to 15% allocation to China. Now, over the course of this year, the equity 100 did have a slight underperformance compared to the benchmark because of partly because of China exposure, as well as some other factors as well. But overall, the portfolio has still generated a pretty good year-to-date return, which is north of 10%, if I'm not mistaken. So overall, the portfolio has done very, very well. Now, again, what we want to emphasize to clients is don't look at performance just from a very short-term lens perspective. There are a lot of folks who will just zoom in on portfolio performance only for a specific period and highlight that the portfolio is underperforming or overperforming. The same portfolio, by the way, in 2020, massively overperformed because the China markets was roaring up, right? So there could always be years where there can be underperformance and overperformance of certain sectors and certain factors as well. What I think is more important is to remain invested and participate in the long-term structural growth story of these individual investments. And that's what we are trying to achieve through these portfolios. We are not really taking a bet on China. That's why the portfolio exposures to China range between 3 to 15% only, not like a 30-40% exposure to China, which can have that detrimental effect on your portfolio performance overall. You saw, I think, when Samantha, you were covering those slides in terms of some of the more popular China ETFs like MCHI, as well as I guess a technology ETF, which are down like 17 to 30% year to date, versus our portfolios across the board are positive for the year. So again, that's I think the power of remaining diversified and not putting all your eggs in one basket.
On that point, there's some questions around our view on whether we see China or the US outperforming going forward. Do you want to take a stab on that, of your view, and then I can give my view.
Yeah. So see, I think while relative outperformance or underperformance is always like a coin toss, in my opinion, right? If you look at the last 10 years, US has just had a preeminence in terms of returns. No matter whether it is the Chinese market or the broader emerging markets or the developed markets, everything is lagged compared to the US market when it comes to historical performance. Now, does that necessarily mean that performance going forward will also be dominated by the US? Ideally, not, right? Like there are better growing economies across the world. A lot of the US sort of market outperformance more recently is also dominated by huge fiscal and monetary stimulus programs. So we will also have to evaluate that how these policies map up in the near future as well as long-term perspective as well, and what are the long-term growth opportunities that we see not just in the US but across the world. And that's why it is important to have a portfolio without thinking of one over the other, rather having a blend such that you participate in all these growth opportunities.
Great. I think there's maybe time for one more question. There's quite a few on this, so I want to get this through. Is how we rebalance and how often we rebalance our portfolios.
Right. So we rebalance all our portfolios on a 6-monthly basis. Every 6 months, we reevaluate all these portfolios and re-optimize them. Again, these are done in a very systematic, rule-based manner. And what that means is each of these factors will be evaluated if they make sense from a long-term standpoint in terms of generating better risk-adjusted returns. They will, keep figuring in the portfolio. Now, the composition of the portfolio might change a bit depending on, the overall risk and return of these components per se. And that's, I think, if you think about it in a more sort of a technical term manner, what we are really trying to optimize for you is the risk-adjusted return, or what is called in financial jargon terms, Sharp ratio of your portfolios. So that is what I think is the guiding principle of our rebalancing strategies. And this happens in a systematic manner every 6 months.
Okay.
Any other things for us to cover, Sam, or we've covered most of it?
I think that's most of it. Well, it was a bit more specific, but yeah, I think that's most of the questions.
Great. I think, like, if we are not able to answer some very specific questions, as I shared earlier, please do reach out to us directly on our webpage. There is a way to reach out to our advisory team. We also host weekly open houses with the advisory team. So the next one will happen next Tuesday. I'm not sure if Vivian is here, if she can post the link. There is a Calendly link for everyone to sign up for that. So if you have more pointed questions about our portfolios and how to think about different kind of goal analysis, that would be a great session for all of you to attend. So if Vivian, if you could share the link to the Calendly registration, such that if people have more questions, they can sign up for it. Otherwise, thanks everyone for joining in today. It was a pleasure and hope you have a good evening. Thank you.
Thank you.
And thanks, Mantha.
Thanks, Ritesh.
Bye-bye.